component of Bank of New York Mellon. Mellon is about 100 years old itself.
About 150.
150 years itself. So I would say in the topsy-turvy, crazy, insane environment of American finance, the institutions that came together for Bank of New York Mellon have been an extraordinarily consistent component in the environment. And Gerald Hassell himself joined the Bank of New York when he graduated from business school, was it, or college originally?
College, yep.
College, and has been with it in his entire career. So, when I was younger, people talked about the staid world of banking. I think now that I'm older, they talk about the insane, crazy world of banking. But this has been an institution that has managed to survive all those things, and a person who's managed to stay in that sort of environment. So the last comments by Mr. Shea, were you listening to his comments?
I got a chance to listen to most of it, yes.
So he, as far as his surprises for the year ahead, and I don't mean to just buttonhole you into a small spot, but he said he wouldn't be surprised next year if there was a shudder in the system among the financial institutions. So let me ask you two things. What has changed now in terms of risk? And I know that you're very much a part of that. And what do you see going forward?
Sure. And, I'll start with the financial institution side, or a little bit on the economy. The surprise that, if you were to characterize the surprise for next year, I actually think the U.S. economy is doing quite well. Underneath all of the numbers, housing prices are starting to recover. The consumer's in good financial shape, relatively good shape, and recovering. Corporate America is in fantastic shape. The financial institutions' leverage has come down enormously. Liquidity is up. What the regulators around the world are trying to do vis-a-vis reducing the risk in large financial institutions, I think is actually occurring. And the managements of large financial institutions clearly understand that we went into the financial crisis way over leveraged and were simply too risky, and we all learned our lessons. And so I do think what the regulatory bodies are trying to accomplish is actually good and sound, and having very, very positive impacts in the sense of the safety and soundness of our financial systems, and particularly the large financial institutions who clearly are the riskiest in terms of how the system operates around the world. So I do think the financial institutions are quite healthy here in the US. They're improving in Europe and in other parts of the world. So I think the underlying aspects of continued growth, or even accelerated growth in the US, are here and available to us. There are some things that are holding us back. Clearly the unemployment rate, the persistently high unemployment rate in the US is a challenge. And Scott, I heard in his comments, I think he's absolutely right. Corporate America or companies like ours are replacing human capital with financial capital. And so we're getting much more efficient in putting other capital to work rather than individuals, and using technology as an advantage to drive our business models. So I think you have all of those elements brewing, but the one message I would send to the audience and to your readers and listeners is I do think the financial system is much, much, much healthier today than it was 5 years ago, and I feel quite confident that the financial institutions are poised to help that economic growth.
I'm looking for questions, but I have one myself. So, why don't we... Wait a second, we're going to have a microphone, and please identify yourself too.
Hi, my name is Joshua Gubitz with GlobalSphere. It seems like there's been so much hand-wringing over the past 5 years regarding what got us into the crisis and how to avoid it happening again. But I've heard what seems to be surprisingly little discussion of a return to Glass-Steagall, which seems like something that would do an enormous amount to prevent something like this from happening again. And I wanted to hear your thoughts on, first of all, should there be more discussion about this? And if not, why not? And what your reaction would be?
Sure. Well, let me first start by saying, we're not in the businesses that Glass-Steagall really was attempting to deal with. Because our institution, for example, I could tell you all the things we don't do, and then you would wonder what the heck do we do? So we don't do retail banking, we don't do credit cards, we don't do mortgages, we don't do investment banking, we don't do all the things that one might describe partially caused us getting into the financial crisis. What we do is we manage money on a large scale for institutional and wealth management clients all around the world, and we service financial securities. And what does that mean? We custodize, we clear, we settle any type of financial instrument that you can possibly think of in any currency in any market around the world. So we provide the network and the connectivity to the financial marketplace. Think of us as the neural network for how the financial markets operate. And so Glass-Steagall for us is not an issue, one way or the other. Now, putting that aside, I don't think Glass-Steagall and the combination of investment banking and commercial banking were the real root cause of the financial crisis. I think the real root cause of the financial crisis, like most crises, economic crises, in many ways starts with real estate, and it starts with lending. And it starts with over-exuberant underwriting standards. It starts with valuations being crept up, and then you started to mold into putting those, poorly underwritten securities, assets, loans into securities, and then slicing and dicing the securities, and then selling them to parties who had no idea what they were buying, and on and on and on. And so I don't think that the root cause was the fact that investment banking and commercial banking were together. I think the root cause was just much deeper than that in terms of every one of us, all the way from the consumer to public policy, had a hand in what caused the financial crisis. The financial institutions exasperated it, no question about it, because they were the packagers of these loans and these securities that were sold to unsuspecting buyers.
So I was going to say, where do you see risk that maybe has come into the system since all these changes have been made? And maybe along your lines, what would be a better way to address it than going back to a law that maybe wouldn't have applied to the problem anyway?
Sure. And I think this is where the institutions themselves and certainly where the regulatory bodies around the world are addressing this. One, let's start with more capital. Let's make sure that there's more buffers to absorb losses should losses occur, because financial institutions are in the business of taking risk. That's what we do. And if we didn't, then there wouldn't be impetus for economic growth. So the question is making sure there's sufficient capital to absorb losses. The second issue is making sure there's sufficient liquidity to absorb potential runs on financial institutions. Both of those key ingredients to the stability of financial institutions are being addressed by either the Basel Committee universally across the globe, or here by the Fed and the various regulators here in the US, or by the FSA, or in the UK, and various other regulatory bodies. So they're all coming at it basically the same way. Different levels, different definitions, and that's one of the challenges for a global financial institution, is the fact we have different levels and different ways to describe these. But the fundamental issue is more capital, more liquidity to absorb bad things that happen, because you do go through economic cycles and you will experience losses. What you want to make sure is that those losses can be absorbed by the institution or by the shareholders, but not by the depositors.
So is there anything that we should be hoping for? Is there any sign that we may see in the year ahead that it's being addressed? I mean, is there anything the audience here should step away and say, well, if this happens, this is good or bad, or we really like to see?
Well, I think you're seeing, certainly here in the US, the president's spoken about it, the Secretary of Treasury, Jack Lew, has spoken about it. They want to get as much of the rule writing done as humanly possible this year or early next year. We could hear about the infamous Volcker rule as soon as next week. You're hearing other regulatory bodies around the world wanting to get the vast majority of the rule writing done by perhaps middle of next year. I think there's a reasonably good possibility that the basic structure can actually be done by the middle of next year. That'll provide clarity to the financial institutions about how they manage themselves, and then what kind of businesses and offerings they offer to the marketplace.
So one of the things that I think many people have felt about the administration is that there may be a healthcare act that is very simple in its phraseology, the Affordable Health Care Act, but very complicated in how it actually manifests itself. Dodd-Frank may sound very simple, and it's to resurrect, but it's very complex. Volcker, we expect to be about 1,000 pages coming out next week. Even if they come out with a rule that says it's a Volcker rule, do you have an expectation that it'll be sufficiently clear enough that it will actually be, it will affect things in the way that you would hope that they would affect them? And will the costs of trying to deal with that outweigh any benefit?
Well, there's a couple of questions in there.
I'm sorry.
So I'll start with, and I describe this, to our own team and to our own directors, and this is not to, cry wolf or woe is me, but the financial institutions right now are dealing in 3 or 4 dimensional chess because we have so many different types of levels and definitions, some of which are binding in one country, some of which are binding differently in another country. We're just having a hard time sorting through, and many of them are still being proposed. So we're trying to anticipate the proposals as well as the existing, and then figure out what's the right capital level, what's the right liquidity, what's the right business structure for our firm, be able to deal with the new world order. While it'll be 1,000 pages for Volcker and 1,000 pages for this and 2,000 for that, it'll at least provide some clarity in terms of the basic framework within which we have to operate. The actual compliance, the day-to-day compliance with it, to your point, will be very, very expensive. It already has been very expensive to the large financial institutions. It's a cost that we should bear to make sure that we are safe and sound. But it is very, very expensive to comply with the level of detail that's being offered up in all of these various proposals.
Question out there in the, yeah, there's one right behind, yeah.
Yeah, Jan Rosenquist, I'm an emergency physician. The withdrawal of the federal stimulus money to the market, buying bonds, will that adversely affect the stock market? Are we stable enough now that we'll level out?
Sure, and this is a personal opinion. I think we've been buying, the Federal Reserve's been buying bonds for too long. It's creating an artificial level of interest rates, and over time will create an artificial comfort in that the liquidity provided by the Federal Reserve will be there forever. I actually think it's also, in the long term, impeding economic growth rather than stimulating economic growth. I think one of the things, the potential surprises, as we're starting to see the economy recover in the US, they can start to taper the bond purchases. That will cause at least intermediate interest rates to start to rise to a more normal level. That will actually give investors a better return, which is good news because the savers of our country are actually being penalized right now. They cannot get any return on their investment in a safe investment. So will it have a dampening effect on the equity markets? Perhaps, but I think it will have a positive impact on the fixed income markets. You'll see an immediate adjustment downwards in price, but you're going to get a better yield and have a better prospect for yield over time. So I think the faster we get to more normalized interest rates, the better off we're going to be, and that'll be a sign that the economy is actually recovering.
Another question here? Yeah, is there one over there? Yeah.
Hi. My name is Zoe. I'm with NPR. And just speaking of yield, I guess my question is, where are the high yield investments right now, really? We sort of had these exotic financial products and emerging markets aren't doing so well. So, where is the money going for the risk takers and what's going to be popular next year?
Sure. Great question. If I knew the answer, I would be rich and not sitting here. But no, seriously. I think that is one of the challenges and why you're seeing the equity markets, particularly in the U.S., being as strong as they are. Because, in fact, Scott said the same thing, as I understood him. His clients and our clients are doing the same thing. They are looking for some level of investment return. And with the equity markets historically over time outperforming fixed income markets, you're seeing more confidence to go back into the equity markets. And there's no yield in the fixed income. And you think of pension funds who have long-term liabilities who don't go away and in fact are increasing over time. And they traditionally invested in fixed income securities. Without being able to get a yield in fixed income, they're having to find alternatives. And so one of the places people are going are, quote, alternative assets. And so you're seeing a pickup in allocations to alternatives, real estate, commodities, oil, a variety of different instruments, private equity funds. And so you're seeing a greater shift in allocation from pension funds, endowments, foundations, private clients into the alternative asset class rather than the traditional equity index funds or individual stocks or fixed income. And so a greater percentage is clearly moving in the alternative space, and we see that as a long-term trend.
Looking at the risk again, I saw there was an interview with Michael Lewis, very prominent author, who wrote The Big Short and other things.
yeah.
And he said he's writing a book on where the next big thing is going to blow up or something, and it comes out in the middle of next year. And we're, as financial journalists, we're always looking at what would be scary. And I think as head of a bank, you must be looking at that too. So is there any place you see risk kind of gravitating to that may not be having been as addressed as well as all the other risks that you have this year?
Well, the number one risk for me that I worry about every single night, cybersecurity. It is real, it is serious for us as individuals, for us as institutions. We have to do everything in our human power to make sure we can protect the data, because we all are living in a data world, a digital environment. So to me, that's the number one risk that we worry about as an institution, and it's for individuals as well.
Is there a second one that you might be seeing next?
I think that the other risks are making sure to, again, to the commentary of the previous panelists, we want to make sure that large institutions get past this belief that we're too big to fail. I absolutely firmly believe the public policy, and for our institution, if we screw up, we should fail. I don't think any institution of any size should be allowed to continue to survive if they have not performed to the standards that one expects. The issue is, how do you resolve that financial institution in an orderly fashion to have as least impact as possible on the rest of the marketplace?
And we've had some progress on that.
I think we've had enormous progress on it that's probably not well recognized yet.
So I'm going to give you a choice. Another surprise for the year ahead, or, Alexander Hamilton founded this bank, and it's been a remarkable story. It's still not that far from where it was founded down the street. If he were in your shoes, or you were Alexander Hamilton now, looking 230 years ahead, any predictions? You have a choice in 2014, or whatever 230 is, plus 2,143. You can pick your year and your prediction.
Well, I think Alexander. Yeah, I think Alexander Hamilton and the founding fathers both took a huge bet on America and what it could do, and I would take the same bet 200 years from now as well. I think America's got an incredibly bright future. We have enormously talented people. We have to improve our educational system dramatically to keep pace with the rest of the world. We have to continue to be hungry in terms of our capitalistic environment, because that's what makes us so great as a country. It allows for innovation and creativeness. We have the potential in the next 10 years to be energy self-sufficient, which is enormously game-changing, politically as well as economically. And so I doubled down the bet on America.